Right, it's 11 o'clock. I think we should probably get going. So our guest this week is Con Walsh from ICG Enterprise, who we heard from before, but Oliver Gardy did the talk then. But we get a chance to catch up with how that private equity fund's been doing. As usual, there's not a massive amount of news this week, but a few things that I thought I'd pull out. One is the Chrysalis Investments investment in Starling. 3i Infrastructure's raised some money. And CC Japan Income and Growth's got some subscription shares that might get exercised, we'll see. So Chrysalis first, which is the main one. I mean, we know the story of this. We've talked about it a number of times in the past, but it has been recovering. Since about middle of October, the share price has been steadily climbing and actually come back quite a long way. You think about it, so starting from sort of 50p level up to about beginning in the middle of January. But obviously this week it took another tumble and the discounts widened out again. And this seems to be related to this latest investment that's made. So the end of December NAV was down 13% on the level from 30 September. That's not a disaster. I think that was kind of what was being priced into the share price before. So the main explanation for that was that they were shifting a number of positions from being valued on the basis of what they paid for them to being valued on the basis of what market comparables are trading at. And obviously things taking a tumble since they made these investments. So that, I think, wasn't the end of the world, wasn't taken as the end of the world, and that wasn't the trigger for the decline in the share price. At the time, they had cash of about 66 million and another 12 million pounds worth of Ys. They've been selling that down. And I think the implication is from what they've been doing that they're probably going to sell the rest of that relatively soon, depending on what the Wise share price does. The main thing that they've needed this cash for is to keep companies going through this sort of period where it's not going to be possible for them to raise money in the listed market. And if they try and raise it in the private market, it's going to be a bit more expensive. So it's important that Chrysalis is able to follow on its investments. And so keeping money back for that was definitely necessary. They thought they'd identified a funding requirement of about 20 million quid. So that implied there was still a kind of cushion there, but not a huge cushion in the context of the size of the fund. Then this week, they spent 20 million of that cash pile buying or topping up their stake in Starling Bank. Jupiter had made a tongue dance that they were definitely going to sell this for some months now, because it's sitting in their open-ended funds. As we all know, open-ended funds holding unlisted things can be problematic. Jupiter have taken the position that they really don't want to do this anymore, and that's something that we probably agree with for what they were doing. And so that was their main investment, and that's now been sold. And I think Chrysalis bought about a third of it. And that took the amount that they've got invested into Starling up to about 118 million. But actually, they're sitting on a loss on this at the moment, which obviously doesn't look too clever. And the reason is that that Starling value has been written down quite aggressively since June last year. So it was valued at 196 million pre the 20 million investment. That was written down to 113 on 30 September and down again at the 31st December down to 93. And that's all in relation to the falling prices of listed equivalents. So challenger banks prices are going down. I think they would argue that Starling's a better prospect than that. But, that's obviously debatable. One of the things I think that's got some people unnerved is the fact that they paid more for this stake in Starling than that value, that the 93 million value at the end of December implies. And one of the discussions that they sort of raised in this is the possibility they might write up the value of the investment on the back of this. I think some people would be quite dubious about that, but obviously they weren't the only people buying the stake. There were other investors buying it as well, which gives an argument that it can maybe justified. It totally depends. It's completely up to the board what they decide to do about that, but we'll wait and see. The market reaction, has to be said, was obviously not great. and the share price fell. There were lots of negative headlines. Stifel downgraded it to a sell, and its main reason is that they need the cash cushion to maintain the existing investments. This was a deal they didn't need to do, which is definitely true, because obviously the fact that we went through at a higher price than the end of December NAV meant that they weren't going to be diluted if they didn't participate. There's debate about all of this. Winterflood questioned why they wanted to make Starling such a big position in the portfolio. They said it's the largest position. It's not. It's actually still number 2 to WeFox, but they also questioned the kind of optics of buying the stake from other funds run by the manager, and there'd been a couple of question marks about whether Jupiter sort of made them do it. I think that's very, very unlikely. And Numis raised the question of whether perhaps shareholders would prefer them to spend that money buying back their own shares. And I think, again, the market would have taken a buyback much more positively than this deal. But there must be a good reason why they've done it. Starling is profitable now, and that profitability seems to be accelerating. So it does look as though that they are actually quite healthily profitable, based on what Anne Bowden said at the beginning of the year. You can see there. And she's been talking about an IPO of this company within about 2 years, about a year ago. So the implication is, depending on what markets are doing, that we could be looking at an IPO for this in the latter part of this year, maybe early next year. And Chrysalis themselves have said that some of their bigger investments might be source of cash flow in the future. And they quite convinced that. Here's the portfolio. Sorry, I had to chop it up in half to fit. But they're convinced that some of the more mature things in here might get sold relatively soon. The one that we think is most likely is Brandtech, which is the digital advertising business that I think is also a holding in Edinburgh Worldwide. Maybe some of the other Baillie Gifford funds as well, but I'm not quite sure. I have to go and check that. That seems to be, that's been written up. As you can see, that's why the percentage of the portfolio has gone up. That's when we did our last note, 18th of August. So I think that might be quite likely to get sold at some point. Obviously, the impact of selling something that's 13% of the portfolio, they'd be adamant that they wouldn't do that unless they were going to get a decent uplift from that as well. So we're talking about cash coming in that could be 15, 16, 17, I don't know what percent of the portfolio. That cash changes the dynamics of the fund completely. So where we had this sort of debate about whether the cash cushion is too small, if they get the cash in, they can then think about returning some of that in the form of buybacks. I think that would catalyse a big jump in the share price. So that is the bull market story, if you like, but you've seen some of the bear market ones. Starling now is up there, number 2 position. As I said, it's progressively written down since last summer. Again, that could be up on the chopping block. WeFox seems to be going very well. When they had the couple of presentations at their Capital Markets Day last year, the business is trading very well. I didn't get a sense from the management that they're desperately looking to sell it, and that's part of the reason why these things might not happen, is that there is this whole argument that they've run all the way through that a lot of businesses don't necessarily see the needs to be listed, but nevertheless, it is a possibility. So there you go. I think there are things that could be sold that would transform this, but we're just going to have to wait and see. And I think that they wouldn't have done this deal if they didn't think that Starling was approaching that kind of position. 3i Infrastructure. I wanted to mention this because it is the first big kind of fundraise of the year, actually. Only £100 million, but still £100 million, it's not too bad. And apparently it was oversubscribed, so they had to scale it back. They didn't say how much. It was done at a sort of a modest premium to NAV, discount to the pre-announcement price. So all sort of tick, 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 really, in terms of 3i Infrastructure. They're just going to use the money to pay down the revolving credit facility because they've been making investments and just piling that onto the debt, which is something that they do. They sort of ramp up the debt and then pay it down again. So all well and good for 3i. I think, though, it's the other thing is the read across potentially. So 3i Infrastructure, Pantheon Infrastructure, and 8085 are all doing similar-ish things. And obviously, there's a question mark about the newer funds and whether they're going to be able to execute as well as 3i Infrastructure has. And I get that. But it does seem strange to me that people can be chucking money at 3i Infrastructure at a premium when Pantheon Infrastructure is trading at a discount. And the interesting question is going to be whether 8085, which is coming back to the market for the second time, trying to do this IPO, is actually going to get away or not. So we've got until the end of the month to find out. Maybe this is an encouraging sign that it will happen. Maybe 3i Infrastructure have nicked the money that would have otherwise gone into the 8085 float. We'll just have to, again, wait and see. CC Japan. This is just an interesting little thing that you don't get very much of anymore in the market because there's not very many of these subscription shares left. This is about to disappear. The final day for exercising its subscription shares is the 28th of February. The exercise price is 161p. Subscription shares are trading at half a p because at the moment they're out of the money, but they're only 2p out of the money. And if the thing wasn't trading at a discount, they'd be at a 10p premium. And the effect of having a 10p premium would be that they'd all get exercised and the fund would expand by £43 million, which is quite significant for something that's got a market cap of about 215 or something. So it's all sort of on a knife edge. It's all quite good fun to watch to see whether it happens or not. Whether you want to play it or not, I don't know. We've had, I can remember in my career, situations where you've had similar things. More often than not, these things expire worthless. But if something positive happens on Japan between now and the end of the month, then that subscription share price could go, well, say if it went into NAV, then those subscription share price will be 10p. So, yeah, it's a gamble. It's not something I'd recommend you do necessarily, but I just wanted to highlight the opportunity. There you go. That's enough from me.